Investors love dividends. They offer a steady stream of income. Tech stocks are known for growth, not dividends. But what if you could get both? That's the allure of high-dividend tech ETFs. These funds promise juicy yields from tech giants like NVIDIA, Tesla, and Amazon. Sounds too good to be true? It might be. These ETFs use option strategies to generate income. The most common is the covered call strategy. This involves selling call options on the underlying stocks. This generates premium income which gets paid out as dividends. Sounds tempting, right? But there's a catch. This strategy limits potential upside. If the stock price soars, you won't fully participate in the gains. You've essentially sold away your upside potential for a few extra bucks. Is it worth it? Let's dive deeper. Let's meet some of the players in the high-dividend tech ETF arena. NVDY, TSLY, and AMZY are popular choices among income-hungry investors. They focus on big tech names promising to deliver market-beating dividends. NVDY, as the name suggests, concentrates on NVIDIA, the graphics chip powerhouse. TSLY taps into the electric vehicle revolution with Tesla. AMZY leverages the e-commerce dominance of Amazon. These ETFs sound impressive, boasting high yields and big-name stocks, but don't be fooled by appearances. The devil is in the details. These ETFs come with hefty expense ratios, eating into your returns. And their performance? Well, that's a whole different story. Let's demystify the covered call strategy. Imagine you own 100 shares of Apple. You're bullish long-term but wouldn't mind some extra cash now. You sell a call option with a strike price slightly above the current market price. By selling the call, you receive a premium. This is yours to keep no matter what. But here's the trade-off. If Apple's stock price stays below the strike price, you keep the premium and your shares. But if it skyrockets, the call buyer can exercise their option. You'll have to sell your shares at the strike price, missing out on potential profits. That's the covered call conundrum. You get income today but sacrifice potential upside tomorrow. Now imagine this playing out across an entire ETF portfolio. Are you comfortable leaving that kind of money on the table? Thanks for sticking with us this far, and I hope you found this material valuable. Please like and subscribe the video and never miss our latest. On we go. The proof is in the pudding, right? Let's compare the performance of these high-dividend tech ETFs with simply owning the underlying stocks. Take a look at the data from January 2025. NVDY kept pace with NVIDIA's stock with slightly better performance. TSLY showed a much worse results, trailing Tesla's gains significantly. And AMZY, while delivering decent returns, couldn't keep pace with Amazon's growth. The numbers don't lie. In a bull market, particularly in the volatile tech sector, these ETFs consistently underperform. They might offer juicy dividends, but their total return pales in comparison to direct stock ownership. The allure of high dividends often masks the hidden costs of these ETFs. Remember those hefty expense ratios? They chip away at your returns year after year. And the covered call strategy? It acts like a ceiling on your potential gains. Imagine NVIDIA or Tesla making a major breakthrough. Their stock prices would soar. But your ETF holdings? Stuck at the strike price thanks to those pesky covered calls. You'd be left watching from the sidelines as other investors reap the rewards. Sure, those dividends might seem enticing, but they come at a steep price. Your potential for significant capital appreciation. Don't settle for pennies when you could be making dollars. Don't fall for the dividend trap. High-dividend tech ETFs might seem like a safe haven for income-seeking investors, but don't be fooled. They are a dividend trap, luring you in with promises of steady income while sacrificing asset value. These ETFs are not the answer to your tech investing needs. They are a band-aid solution offering short-term gratification at the expense of capital. There's a better way, a smarter way, to invest in the tech sector and generate income. Want real control over your investments? Buy the stocks directly. Ownership empowers you to make strategic decisions. Want income? Sell covered calls on your own terms, choosing strike prices and expiration dates that align with your investment goals. This approach allows you to participate in the full upside potential of your chosen tech stocks. You're not limited by an ETF strategy or bogged down by high fees. You're in the driver's seat, making informed decisions that benefit your portfolio. Remember, investing always involves risk. Direct stock ownership and options trading require careful consideration and research. Before diving in, educate yourself on options strategies, risk management, and market dynamics. Evervests.com can help. Check out our website for more educational material. Don't let the fear of missing out lead you to make hasty decisions. Informed investing is smart investing. The bottom line? Smart investing for tech gains requires analysis and patience. High-dividend tech ETFs might seem tempting, but don't be seduced by their siren song. They are a dividend trap, limiting your upside potential and burdening you with unnecessary costs. Take control of your financial future. Invest directly in the tech companies you believe in. Utilize options strategically to generate income and enhance your returns. Remember, smart investing involves research, patience, and a long-term perspective. Well, that does it for this one. Let me know what you think in the comments below. Thank you for watching. Until next time, good luck out there. As always, the information presented in this video is for educational purposes and should not be considered financial advice. Be sure to evaluate how these securities align with your financial needs. Consult with a financial professional if needed.